looking forward, it's entirely possible that this 60-40 formula just doesn't work as well as it did before.
Hello and welcome back to the Personal Investor Podcast. I'm Ed Monk and I'm joined by Tom Stevenson, Investment Director here at Fidelity, to talk about a very long-standing and common principle in investing and to ask whether it still has a role to play for investors. That principle is the 60-40 rule for portfolios. It's the idea that a mix of 60% shares and 40% bonds gives you the best blend of growth potential on the one hand and downside protection on the other hand. Tom, welcome along. We're going to come to more recent market movements and what they mean for the 60-40 portfolio. But before that, let's cover off some of the basics. We'll assume people know what shares and bonds are. But Why might those two assets work well together?
Well, the basic principle of the 60-40 portfolio is that bonds and shares respond differently to the same stimulus, to the same event. So, what is good for shares tends to be bad for bonds, and vice versa. Because of that, you get the same event. The shares and bonds move in a different direction. That ends up giving you a smoother ride overall in your portfolio, which is good psychologically as much as anything, because you don't see these big drops and rises in your portfolio, which can be quite off-putting.
Yeah, and you can think of that in terms of when everyone is very confident about the economy, that's potentially very good for shares.
Yeah.
If there's something that knocks that confidence, they might retreat to bonds and prices go up there. That's because bonds are a little bit more secure, aren't they? Basically, if you really get down to it, a bondholder is more likely to get their money back than a shareholder in kind of extreme circumstances.
Yes, and I mean the nuts and bolts of how it works is that if you have growth, then as you say, that's good. That's good for shares. But if you have a growth environment, possibly leads to higher inflation. That leads to higher interest rates and higher bond yields. And as we've discussed before, bond yields and bond prices move in opposite directions. So what is driving share prices higher can also drive bond prices lower.
Yeah, and we'll just dwell on the inflation interest rates part of this and how that impacts bonds, because we're going to probably return to it time and again in this conversation. Bonds pay a fixed income, don't they? A fixed cash income, and that will be eroded away if inflation is higher.
Yeah.
And if inflation being higher leads to higher interest rates, that means there's a higher return on risk-free assets like cash. And that means the market is likely to demand a higher return from a bond, a higher yield, and therefore a lower price.
That's right. I mean, in principle, if you're holding a fixed income asset like a bond, that income will become less valuable as inflation erodes its purchasing power over time. So if you think that inflation is going to be persistently high and high into the future, then as an investor, you're going to want to have a more compensation, more reward for holding that asset. So as interest rates go up, as bond yields will also go up in order to give the holder of that asset more reward.
Yeah, and we're here to talk about the 60-40 portfolio. That means a slightly more, actually bigger than slightly, a bigger allocation towards shares than it does bonds. And presumably, the logic there is that you want the bigger exposure to the growthier, higher growth potential asset, which is shares. History tells us that. So bonds are there as a sort of mitigator, as a sort of dampener, perhaps.
Yeah, almost like an insurance policy. So I mean, if you're investing for the long term, which most of us are, then you want to tap into that superior long-term growth that you get from shares. As you say, history shows that is the case, that the best returns over time have accrued to shares, to equities. So that's why you have more in shares than in bonds. So that the 40% in bonds really is to act as a dampener, a smoother to the ups and downs of that portfolio. But the growth comes from the shares.
Indeed. And what is the record of it working, of that relationship between the two assets working, and of it actually producing sort of good kind of the returns that investors actually want?
Yeah, well, it depends, and there are years in which it doesn't work well. I mean, we had one quite recently actually. 2022 was a notable year in which both shares and bonds fell. And the reason for that, shares fell because interest rates started rising. We had that inflation spike after the pandemic. Shares fell because investors anticipated a rise in interest rates. And the rise in interest rates, when it actually started to come through, was also bad news for bond prices. So we had a year when both bonds and shares fell at the same time, which is not what the 60-40 is supposed to do. But if you look over a longer period, and if you look at sort of rolling 10-year returns from these investments, then it's actually a pretty smooth return. So yes, the 1-year return can bounce up and down a bit, but over a 10-year period, it's really quite smooth.
Yeah, it's funny, isn't it? I guess people, there probably are more years when it doesn't work, when the correlation or the uncorrelation doesn't work, but people tend to remember the ones where they both sort of lose money. That's when you really feel it. There's probably plenty of years where actually they both rise. And we don't say, oh my God, the 60-40 portfolio no longer works because they're both returning in return.
Yeah, and in fact that has been true in recent years, because the last years since the financial crisis has actually been a rather unusual period in which the bond market has been heavily influenced by central banks buying bonds. So they've artificially suppressed the yields on bonds, which has pushed the value of bonds up. So while that process was going on, that was very good for shares because it kept interest rates low, which was good for growth. That was good for the stock market. It was also good for the bond market. So yes, there have been plenty of years when they've both gone up together, which actually is not really what the 60-40 is supposed to do. But because people are making money on both sides of the equation, then they're quite happy with it.
Yeah, exactly. I mean, I guess the aim really is to maybe give up a little bit of upside. And you've spoken about the high growth potential of shares. You give up some of that for better downside protections. I've actually got an example of that working quite well recently. We've done some research. We spoke about it on the pod a few weeks ago. It was to do with what's happened to pension pots in the period since 2015. That's when a bunch of pension changes came along in the UK. And we looked at people withdrawing 4% a year from £100,000 pension pots between 2015 and 2025. And at the end of the 10 years, if they were 100% in shares, they had £189,000 left. So they did work very well. If they'd had a 60-40 portfolio, they had £157,000 left. But that 60-40 mix had dramatically cut the volatility that they'd felt along the way. And in particular, at one stage, very early in that 10-year period, that pot of 100% shares, that had fallen 20% in a year. And the losses for the 60-40 portfolio were half as bad, about £10,000 or 10% of the pot. That was really important in that context in particular, because those people were withdrawing their money. They were extra kind of concerned about losses because they knew that could be very harmful for their retirement fund in the longer term. It worked in that example. It did what you want it to do and what you'd expect it to do. You give up a little bit of the potential growth, but actually a lot easier to handle along the way. And actually, in that example, in both scenarios, went on to do very well and end up with a big amount of money. But at that moment of those big losses, you would have been really, really grateful to have had the 60-40.
Yeah, and that's a really good example because it works on two levels. It works on the psychological level that you've mentioned, which is really important when you go into drawdown, you start taking money out of your pension. What you really don't want is to be taking money out as the market is falling and to see the value of your pot falling by, I think you said 20%.
Yeah.
That would be pretty scary at the beginning of your retirement. So psychologically, it's important to minimize that. But I mean, the other important thing is something that we've talked about on the pod before, this thing called sequencing risk. If you get that hit right at the beginning, that actually has a knock-on effect on the value of your retirement savings for the rest of your retirement. So actually minimizing that early fall is also really helpful.
Yeah, it gives you certainty. I think it's probably underrated. We work in a world full of investment professionals, very numeric, very logical and rational people. And often they can see the value of being in the highest growth potential asset like shares. and understands that that's the place to be.
Mm.
But we're not all like that, and actually there's a value on reducing your downside risk for all the reasons that you say there.
Yeah, it's interesting. I mean, we were talking recently, weren't we, about some pieces that our colleague Richard Evans had written about Warren Buffett, and of course Warren Buffett sort of famously said that you should actually welcome a fall in the market when you're saving for your retirement, because you can buy things cheaply. But that's not how the human brain works. You see the fall in the value of your investments, and it actually has a psychological impact. It puts you off doing the right thing, saving for the future. So the psychology is important.
Absolutely. Okay, so we'll let's overlay some kind of recent events onto all of this. We know that inflation and higher rates are bad for bond prices. We've covered that. That's what we've had since about 2022. How has that challenged the 60-40 approach in the time since then?
Yeah, well, I mean, what history shows is that as bond yields rise towards the sort of levels that they're at currently, the sort of 5% level, then a couple of things happen. One is that the correlation, so the directional move of bonds and shares becomes closer. That they tend to move in the same direction. So you get a rise in bond yields, a fall in bond prices, and that starts to impact the price of shares as well as bond yields rise. When bond yields are low, they can move differently, but they tend to move more in sync. And so I think the situation we're in at the moment with bond yields rising to a relatively high level is potentially quite bad for both bond prices and share prices. So I think that looking forward, it's entirely possible that this 60-40 formula just doesn't work as well as it did before. And that if people are doing it in order to diversify their portfolios and to get this smoother ride, then I suspect that they might have to look further than just offsetting movements in the equity market with bonds. They will probably need to get a broader spread of investments in order to get that smoother ride.
Yeah, and presumably when you do have bond yields at those high levels, a lot of stock market investors will say, actually, well, yeah, I would like an income of 5.5% or whatever it is. And so it just becomes they're sort of competing for assets at that point.
That's exactly right, and that is why rising bond yields are bad for the equity market, because it's a comparative thing, it's a competitive thing.
Yeah.
That if you can get a 5.5% income from what is a relatively safe investment, because you can be pretty sure that the US government or the UK government is going to pay back the money that you have lent them. So it's a relatively not risk-free, but it's a lower risk investment than a stock market investment. If you can get that attractive yield, then why would you take the risk of the ups and downs of the stock market? So that's why rising bond yields are a negative for the stock market as well.
Yeah, and I mentioned this period since 2022. It was then that we had the invasion of Ukraine. We had all sorts of overhangs from the pandemic and supply chain issues. Big inflation at that point. Bonds fell as rates and inflation rose, and the stock market fell on all that uncertainty as well. Really painful year 2022 for investors, because both those assets were falling. Had investors had a greater variety of assets in their portfolios, they might have done a bit better, right? Things like commodities during that period might have helped them out. Gold during the recent period might have helped them out. There is life beyond bonds from a diversification point of view.
Yes, and lots of these other assets, you mentioned gold and commodities, property is another one, just plain old cash is another one.
Absolutely.
They are not correlated in the same way. They move in different ways from each other and different ways from bonds and equities. And I think that what investors will be looking to do is they've thought of bonds as being the diversification away from equities. But I think actually, going forward, they may need to find assets that are diversifiers against both equities and bonds. And so that's why you need to look for, maybe slightly more sort of esoteric things that maybe you hadn't thought about investing in. And gold is a good example. I mean, over the last couple of years, gold has done extremely well. And it has, offset weaker performance in other assets. So it's been a good thing to have a bit in the mix. So we've talked about 60-40. One of our colleagues over in the US has started to talk about a 60-20-20 diversification. So he's looking at 60% in shares still to get that long-term growth, but then maybe 20% in bonds and 20% in other stuff. And he would include in that, gold and commodities and other things.
Well, yeah, I mean, that was going to be my final question. Yeah, we've got golds, commodities, commercial property might be another one.
Yeah,
there are certain funds, aren't there, that sort of make it their business to protect on the downside. They can often be diversification.
Yeah, that's right. Sometimes they're known as absolute return funds. I mean, they are funds which again will probably have a very diversified set of investments, and they are designed to perform more or less regardless of what's going on in the market. So they will try and capture gains whether the market is falling or rising. Don't always succeed in doing that, but as a small part of a balanced portfolio, then they probably have a place going forward.
And just finally, this is a bit of a headache for investors, isn't it? I mean, it was easy. It used to be so easy, right? You would, particularly in that, they used to talk about a 30-year bull market for bonds or whatever it was. Didn't really take much sort of thinking, really. It does now. How should investors approach it? I mean, there are ready-made solutions for this kind of stuff, but presumably it does need a bit more kind of legwork as well.
I mean, I wrote a piece a week or so ago in which I think my opening line was, it probably didn't seem easy at the time because it never does when the markets are going up and down. But actually, just buying this 60-40 portfolio delivered a high single-digit return with low volatility. That's a pretty fantastic. If you can do that year after year after year, then you're very happy. I think it is going to be harder going forward, and the key, and I talk about this a lot, is just diversification. It's even within that 60% allocation to equities. Think about it's not all in one market. It's not all in the US, but having, different geographical allocations as well as those multiple asset allocations as well.
And just to repeat a theme that we have spoken about on the pod before, sort of mentally process the fact that you're diversifying elements in your portfolio are sometimes going to drag on your overall performance.
Yeah.
There are going to be moments when you really wish you didn't have them.
Yeah.
But that's not what they're there for. And it's not those moments they're there for. They're for the other bits when shares are falling and bonds are looking less.
Oh, yeah. I mean, with the benefit of hindsight, you can look back over the last 10 years and say, well, I should have put all of my money in the US stock market. Well, yes, of course you should. But, you didn't know that at the time.
Yeah. Okay. Well, that does just about cover it, Tom. If you found this useful or interesting, please do hit the like button and maybe even subscribe or share or leave a review. It's going to help many more people find this content. That is it for now. Tom, thanks for joining me.
Thanks, Ed.